The price you saw this morning was $84.70. That number on the COMEX, the commodity exchange in New York, the world's benchmark for silver futures, moved nearly $2.13 higher from its Thursday close of $82.18, a 2.6% single session gain. The financial press will tell you it's the Iran conflict. And they're not wrong, but they're only reading the headline and skipping every footnote that actually explains what's happening to this market right now. Because the Middle East crisis didn't create this situation, it exposed it. And the exposure is the story. Here is the number that should stop you. According to publicly available CME Group data, total open interest on the front-month COMEX silver contract currently represents well over 400 million ounces of paper exposure. Registered silver, the metal that is actually warranted, sitting in vaults, legally available for delivery against those contracts, has fallen to roughly 86 to 110 million ounces, depending on the day you check. That's a coverage ratio below 15%. For every 1 ounce of metal that can actually be delivered, there are somewhere between 4 and 6 paper claims lined up. And something just happened in the last 8 days that is going to force those numbers to face each other sooner than the market expected. The Iran conflict didn't break the silver market. The Iran conflict is the light being shined on a room that was already in pieces. By the time we're done here, you'll understand why $84.70 is not the real clearing price of physical silver right now, why Shanghai is signaling something entirely different, and why the 3 things you need to watch in the next 72 hours are specific, verifiable, and will tell you everything about which direction this resolves. On March 4th, 2026, just 4 days ago, the CME Group's own warehouse reports showed registered silver inventory had been declining at roughly 21 million ounces over the preceding 30 days. That's a 20.7% drawdown in 1 month. At that rate, the registered pile would be exhausted in approximately 80 trading days under normal conditions. But conditions are not normal. They haven't been normal since January, when a single week saw 33.45 million ounces pulled from COMEX vaults, 26% of the entire registered inventory vanishing in 7 days. That is not investors doing paperwork. That is industrial users and institutional holders who no longer trust that the metal will be there when they need it, taking physical delivery now rather than rolling forward. The February delivery cycle confirmed this shift structurally. COMEX reported that 5,036 contracts stood for delivery in February, equivalent to 25.18 million ounces, the highest February delivery volume in modern exchange history. On first notice day alone, January 29, 1,881 contracts were presented for delivery. To put that in plain terms, the first 3 days of February saw 2,765 contracts exercised for physical delivery, 54.9% of the entire month's total, front-loaded in a way that has never happened at this scale before. The people standing for delivery were not waiting. They wanted the metal immediately. Now set that data point next to what is happening in Shanghai. The Shanghai Gold Exchange, which is China's primary physical precious metals market, overseen by the People's Bank of China, operates on a fundamentally different model than COMEX. Fewer than 1% of COMEX silver futures contracts result in physical delivery. The SGE is designed so that traders take actual metal. When the SGE price rises above the COMEX price, that is not a tax artifact. That is the physical market telling you what real silver, deliverable today in the hand of someone who actually needs it, is worth relative to a paper promise in New York. In late December 2025, the Shanghai physical premium over COMEX hit $8 per ounce. In January 2026, analysts at the Investing News Network documented a physical silver coin being sold in Dubai at $99.93 per ounce on a day when the COMEX March contract settled at $72.26. That is not a premium. That is a bifurcation. Here is the piece of this story that most mainstream coverage has skipped entirely. On October 30, 2025, China's Ministry of Commerce, MOFCOM, announced that beginning January 1, 2026, all Chinese silver exports would require a government license. The licensing framework replaces the previous quota system and effectively restricts 60 to 70% of the global silver supply that previously flowed from Chinese mining and refining operations into Western markets. To qualify for an export license, a firm must produce at least 80 tons of silver annually and secure $30 million in credit lines. That threshold eliminates the majority of Chinese silver exporters from global trade. China's state-run Securities Times cited an unnamed industry insider confirming this move formally elevates silver to the same regulatory status as rare earths, strategic materials over which Beijing exercises explicit geopolitical control. The United States added silver to its critical minerals list in November 2025. MOFCOM announced the licensing framework 1 week later. The Middle East conflict, the coordinated U.S. and Israeli strikes on Iran that began February 28, 2026, has introduced a second layer of pressure onto a market that was already structurally compromised. And this is where the story gets genuinely complex, because the two pressures are pulling in opposite directions for silver's two different identities. Silver is simultaneously a monetary safe haven metal and an industrial input. When war breaks out, the monetary side surges. The gold-to-silver ratio compressed toward 57 in the first days of March, as silver briefly touched $96.40 on March 2nd before selling off intraday 7% to the high 87s. That kind of move, up $14 from 1 week and then back $9 intraday in a single session, is what happens when you have an asset experiencing simultaneous demand from two completely different buyer classes who respond to the same news in opposite ways. Safe haven buyers rush in. Industrial demand hedgers, facing recession fears from an oil shock, temporarily hesitate. But the Iran conflict has introduced a specific supply shock that goes beyond the normal safe haven narrative. Dubai is a primary transit hub for physical silver flows from Asia to the broader Middle East and African markets. When Iranian strikes grounded Dubai flights in early March, reporting from USA Gold confirmed those groundings directly disrupted global bullion supply chains. Bars that were moving through Dubai stopped moving. The physical market in Asia tightened further, not from demand changes, but from a logistical interruption. The dollar index, the DXY, rose to near 98, a 5-week high, as safe haven flows into the greenback also arrived. That dollar strength typically suppresses commodity prices quoted in dollars, yet silver still held in the mid-80s through this weekend's open. The fact that silver is holding against a strengthening dollar tells you something structural is holding the floor. Here is where a historical parallel is worth examining carefully, because the structure of what is happening now is not without precedent, but the magnitude is different from anything documented before. In March 1980, the Commodity Exchange implemented Silver Rule 7, which imposed severe restrictions on buying silver with leverage, effectively ending the Hunt brothers' attempt to corner the physical market. The mechanism then was straightforward. Two individuals and their associates had accumulated an enormous paper and physical long position that outstripped deliverable supply. The exchange changed the rules. The price collapsed from near $50 to under $11 in weeks. What is different today, structurally different in a way that makes that comparison insufficient, is that the current delivery pressure is not coming from two speculators. It is coming from the industrial sector. Solar panel manufacturers require silver for photovoltaic cells and cannot substitute it. Electric vehicle producers use 25 to 50 grams per vehicle for electrical components. The AI data center build-out depends on silver for circuit connections. These buyers do not roll their futures contracts. They need the metal to make things. COMEX cannot change the rules to eliminate industrial demand the way it changed the rules to eliminate leveraged speculation. You can adjust contract terms, you cannot adjust the periodic table. And this is where the institutional side of this trade has become genuinely uncomfortable for parties on both sides of the ledger. Let's address the counter-argument directly, because it deserves full treatment. The strongest version of the case for orderly resolution goes like this. COMEX has handled apparent paper-to-physical imbalances before. The eligible silver inventory, which is not immediately deliverable but sits in the same vaults and can be converted to registered status in 24 to 48 hours, provides a real buffer. Warrant transfers mean the same bar of metal can satisfy multiple delivery obligations without physically moving. The exchange has emergency powers to modify contract terms, compel cash settlement at market rates, and coordinate with regulators to prevent systemic failure. This is the mechanism argument, and it is not wrong. COMEX has survived stress before. What this argument misses is the rate of change. The February delivery rate was 12 to 22 percentage points above historical norms for that contract month. The same analysis that notes eligible to registered conversion takes 24 to 48 hours also needs to acknowledge that owners of eligible silver must choose to offer it for delivery, and if they are industrial users holding that metal as operational inventory rather than financial exposure, they have no incentive to convert. Their eligible silver is their buffer stock. They are not selling it at current prices. They are holding it because they need it. The honest uncertainty in this analysis is this. The market can produce outcomes that defy the structural math for longer than seems rational. Cash settlement agreements, quiet bilateral arrangements between large shorts and longs, coordinated inventory movements by major bank vault holders. These things happen in ways that are never publicly disclosed. The direction of the data is clear. The timing of when that data forces a price resolution is genuinely uncertain. What you can verify for yourself, without relying on anyone's interpretation, are three specific things over the next 72 hours. The first, CME Group's daily vault report, published at approximately 6 p.m. Eastern each trading day, beginning Monday, March 9th. If the registered inventory number drops below 80 million ounces, the coverage ratio against outstanding open interest falls below 14%. Watch the number, not the commentary around it. The second, the Shanghai Gold Exchange benchmark for silver, the SGE AG T+D contract, will set its reference price during Shanghai trading hours Monday morning, which is Sunday evening Eastern Time. If the Shanghai to COMEX premium widens beyond $5 per ounce again after this weekend's market open, it signals that the Iran conflict's supply disruption in the physical transit network is not easing. The third, the Federal Open Market Committee meets March 17th and 18th. Markets are currently pricing one rate cut this year, pushed back from earlier expectations of two cuts because oil-driven inflation fears from the Iran conflict have shifted the Fed's calculus. A hawkish signal on March 18th would strengthen the dollar and create temporary downward pressure on silver's paper price. That divergence, a falling paper price against a persistent Shanghai premium, would be the clearest confirmation yet that the two markets are no longer functioning as one. What the data assembled here points to requires saying precisely, without exaggeration. Two markets are currently pricing the same commodity differently. Not because of taxes or transit costs alone. Those are real, but they don't explain an $8 to $10 per ounce gap between a physical delivery exchange in Shanghai and a futures exchange in New York. They are priced differently because one market primarily values the promise of metal and the other primarily values the metal itself. For the last several decades, those two valuations have been close enough that the gap was noise. The structural conditions of 2026, China's export licensing framework removing 60 to 70% of previously available global supply, 5 consecutive years of demand exceeding mine production, U.S. critical mineral designations, COMEX registered inventory at multi-decade lows, and now a physical transit disruption through the Dubai corridor caused by the Iran conflict, have made the gap too wide to be noise. The Iran conflict is not the cause. It is the accelerant poured onto kindling that was already dry. The question worth sitting with is this. The SGE was pricing physical silver at a premium when COMEX was at $72. COMEX has since moved to $84.70. If the structural tightening in physical supply has not resolved, and the CME Vault data says it has not, where does the Shanghai premium settle relative to a COMEX price that has itself already moved 17% in 6 weeks? Leave your number in the comments. If you have a specific view on where the SGE premium lands relative to COMEX by the end of March, and the data reasoning behind it, I'll pin the most analytically rigorous response. Not the most bullish, the most reasoned. The Federal Reserve's next rate decision is March 18th. I'll have the overnight analysis published before the U.S. market opens that morning. If you're not subscribed with notifications on, you'll miss it on the night it matters most. Everything in this video is sourced from public data, CME Group warehouse reports, SGE benchmark data, MOFCOM policy documents, USA Gold daily market reports, the Investing News Network, Bloomberg, and Trading Economics, all linked in the description. I'm not a financial advisor, and nothing here is investment advice. Every number cited here is verifiable independently through those sources. Verify it yourself. Make your own decision. The data is public. The interpretation is yours.